Welcome to our State of the Markets update. We are going to be covering the capital markets, what's happened in investments over the last quarter, and also give a preview to how we think about investment rates of return and investing with the election in November up ahead. From a big picture perspective, the U.S. stock market was up a little over 6% in the third quarter. International stocks even did a little bit better, with the developed markets up 8.2% and the emerging markets up just south of 9%. The U.S. bond market was up as well, with interest rates across the yield curve coming down, pushing bond prices up. The U.S. bond market as a whole went from negative territory in the first half of the year up to a positive rate of return in the third quarter, up 5.2% in the third quarter alone. The global bond market didn't perform quite as well, only up 3.5% in the third quarter, simply because global interest rates across their respective yield curves didn't come down quite as much. We have that seesaw effect again, whereas bond yields come down, their prices move up, and that was the key driver of the return over the last quarter. Turning to stocks, you can see that the U.S. stock market did well as a whole, with each area having a positive rate of return. Smaller companies led their larger counterparts. They were up 9.3% versus large companies being up 6.1%. And value companies outpaced their growth counterparts, up 9.4% versus 3.2%. If we look at international stocks, the same story basically applied, with small companies outpacing their large counterparts, 9 versus 8%, roughly speaking, and value companies up 9.5% versus their growth counterparts, only up about 7% on the international stage. If we look at what's happened in the bond market year to date, the first 9 months of the year, you'd see that Treasury inflation protected securities have been up about 5%. Shorter term U.S. Treasuries, the 2-year Treasury up 4%. The longer term Treasury, that 30-year Treasury, only up 1.4%. That dynamic there is still that interest rates have risen on the 30-year Treasury since the beginning of the year. As those yields have risen over the course of 9 months, we still see a dynamic where the bond prices have been pushed down just a little bit. There's still a robust yield there relative to where we were 3 years ago. But to see the 30-year Treasury perform really well, we would need to see those interest rates come down a little bit more on the long end of the curve. As a whole, the U.S. aggregate bond market, and aggregate here again as a reminder is the corporate bonds that are investment grade and the U.S. Treasury bonds, along with agency-backed securities and some other types of fixed income. There is a whole up 4.5%. These don't include things like high yield bonds or reinsurance bonds or some of the other non-agency mortgages. But that U.S. aggregate, that corporate and Treasury bond market, up 4.5%. The best performer so far this year among those categories that we track, the reinsurance bonds, up about 13%. Now, as we're filming this, Milton has come about as a major hurricane, and so we don't know the impact there. Reinsurance bonds, again, pay us well on a basis of a higher yield, but they are exposed to the claims of significant weather events, be that a hurricane, be that wildfires, or other kinds of events that we may see. Oftentimes, clients will say, well, how should I think about the market? Is it a spot where I can expect really strong rates of return going forward or not? What should we do as we think about the election cycle coming up? We're going to do a deeper dive on the election itself, but one of the ways that we gauge the long-term potential of the stock market as we think about the next 5 to 10 years is we think about where do stocks sit right now relative to their earnings and relative to history. So if we have earnings that are really strong relative to the price of a stock, then we will tend to have higher rates of return over the next 5 to 10 years. That's what the research would bear out. If we have a higher price of stocks on average relative to their earnings, we would tend to have a lower expected rate of return going forward. Now, lower doesn't mean that we expect the stock market to turn over and drop 20 or 30%. It just means that we have a headwind of being priced at a little bit more rich beginning point. If we look at where we were at mid-year, at the end of June in 2024, the price to earnings ratio across the board was a little bit expensive, except in small value companies. You could see those large growth companies quite expensive, about 50% more expensive than their long-term average. You'd see whether it's large companies in the value space or blend space or those growth companies there in the mid or small space, even those still fairly expensive. But as we look to current elements coming into the fourth quarter and look at that price to earnings ratio at this point, you could see that it's even more expensive. And whether we look at that across large companies, whether we look at that across growth companies, or whether we look at that as a whole, there's not as many bargains as there were certainly coming into this year, or a year and a half ago as we were coming out of the drop from 2022. Again, that doesn't give us a signal that we need to sell all of our stocks, but it does mean that we can expect some headwinds and slower rates of return over the next 5 to 10 years in all likelihood. Another way that we look at this is the Z-score, looking at the past 20-year average valuation. If we do these calculations, we think about kind of one standard deviation away from that central point as being a good marker of whether a stock or a bond is more expensive or less expensive, or a particular area is for that matter. And you can see that on the left-hand side that core bonds are actually relatively inexpensive compared to their last 20 years. Coming into this year, they were even more inexpensive or cheaper than they are now. They've gotten to be a little bit more expensive. If we look at municipal bonds, there really hasn't been much of a change in the municipal bond market. They're priced kind of in line with history. If we look at international developed equities, this would be Europe, Japan, Canada, Australia. You could see that we entered this year with international developed stocks being a little bit cheaper than normal, and now they're kind of back in line with history. But the thing that we want to highlight is that U.S. stocks, whether they're small, large, value, growth, all of them are expensive compared to their histories. Now, some more so than others. If we think about large cap stocks or growth stocks, those tend to be the most expensive coming into this year. But you can see really value stocks in the U.S. have caught up, and they're just as expensive as their growth counterparts in some ways. Small companies still tend to be less expensive than their large counterparts, but again, metrics would suggest that they're a bit more expensive than history. So these pieces in line with that I just showed you again would suggest that instead of looking at a long-term average rate of return that might be something like 9% going forward, we should probably take a haircut if we're looking at that higher price point coming in from this starting point. One of the questions that we get most often is, how should I look at my investments with the uncertainty of the election in November in mind? As we look at where the polls are, as we look at what prognosticators are suggesting, it's really a coin flip right now in terms of who might win the White House. I'm never going to suggest that a client should bet on a U.S. election, but if we look back in the past, those betting markets are those that tend to do a better job than, say, the polls in being able to diagnose who may actually win. And right now, I will tell you, across each one of the different arenas, those markets are basically a coin flip. So an election that's far too close to call, not just the U.S. presidential election, but bear in mind, we also look at the Senate and the House of Representatives as key chambers that will decide what goes forward politically over the next 2 and 4 years. So a lot of uncertainty in each one of those arenas, although it does look like the Republicans may control the U.S. Senate and the Democrats may control the House of Representatives. If we get split government, even more so, that's going to mean that it's going to be hard for either party to be able to drive a significant piece of their agenda forward. With all that in mind, I want to turn things over to Austin, we'll talk about how we think about the election this year, particularly the presidential election, and how we invest as we think about long-term investment and whether that presidential election should have any impact in terms of the way that we approach this.
Thanks, Spencer. So One of the things that we want to start off with is this quote from Morningstar. Research suggests politics is increasingly becoming a stressor, not only during election years, but also during our daily lives. And this is from an article that is entitled, Election Years Are Primed for Financial Mistakes. Here's what you can do about it. And I think as we come into this conversation about what should I do about my portfolio in terms of what's going to happen in the election, we have to take a step back and really recognize that all of our politics, whether we watch Fox or MSNBC or CNN or PBS NewsHour, they're all primed to make us feel something. News makes us feel something. And when we also get our news from Facebook or Threads or X.com or any of these other social media sites, they are really priming us to become really stressed out and anxious about what is to come. And so when we have all of these media outlets that are telling us that we need to be afraid of the forthcoming election, no matter what side of the aisle you're on, it can really cause us that stress. And when there's stress and when money is emotional, we are primed to make bad decisions. And so what we want to do is take a step back and look at what has happened over the last 50, 60, 70 years when there has been an election and say, okay, what do we need to really consider as we move forward here? And so if we look at the S&P 500 year from January of 1950 to September of 2024, what we see is not only just a lot of growth, but it's been a lot of growth. It's also been choppy over time. There are years where it's going to go up. There are years where it's going to drop. And no one knows. We have no crystal ball to say what is going to happen in the future. But as we look back, we continue to get clarity about what is going to happen or what has happened historically. And so we always want to look forward with a grain of salt, saying we can't ever predict, but we do want to say, okay, what has happened in the past may give us a guide to what could happen in the future. So what we're looking at here is the count of monthly returns of the S&P 500 since 1950. So what we're looking at is any time that a month was positive or negative within that band. So you can see on that bottom line, there are different bands from less than 10% all the way up to 8 to 9%. So let's say January of 2024, the S&P 500 was up 1%. Then that bar from the 0% to 1% would rise a little bit. So the bars that are the highest are the count of months where the S&P 500 landed within that range. And so what you can see is between negative 3% to about 5% is where a majority of those months land. So anytime the S&P finished in between that range is probably the highest probability of where it will land going forward. And we see the median monthly return of the S&P 500 over this course of time is about 85 basis points up. So almost 1% of return in the positive direction. Now, again, there are going to be months where it's down 5%. There's going to be months where it's up 8%. But the majority of those returns of the S&P 500 is going to be somewhere in that -4 to +5 range. So we then ask, if we take another step back, we again take the S&P 500, what did it do in those November months where there was a presidential election? And you can see there are some months where a Republican won, where it's in red. There are some months where a Democrat won, and it is in blue. And there are some months that it's positive for a Republican. There are some months that it's positive for a Democrat. There are some months where it's negative for a Republican. There are some months where it's negative for a Democrat. The reality is, as we look at history, there's no real great way to say, yes, this is going to happen. If we look historically, we can look back and say, okay, those two big drawdowns in 2000 and then 2008, we know historically what was happening in those times, that we had the dot-com crash, we had the great financial recession. So there were times where we can look back and say, yes, there were a lot of things that were going on that negatively affected those rates of return. But if we're playing this out as we look forward, it's hard to know what history is happening when we're in the midst of history happening. So the next thing we want to do is take a look and see what happens for the S&P 500 from inauguration day until the next president is inaugurated. And we recognize that time period is a little bit fraught because there's a period between November and January where markets are going to start moving between post-election and when the president is inaugurated. But the reality is, over the course of a presidency, there is a pretty wide array of where Republicans have done well, Democrats have done well, And so we would say, if we're going to look over the next 4 years, we can't immediately determine what is going to happen with our rates of return for our investment portfolios. They could do well. We could have downdrafts. We just don't know. And so when we think about elections, we don't want to come in and say, well, this president is not of my party, therefore I don't want to invest in the equity markets or the bond markets. I want to move everything to cash, because we don't know what the rate of return is going to be in a forward-looking environment. So then we ask, what would happen if you invested your money only when a Republican was in the White House versus only when a Democrat was in the White House? And so what this means is you are starting your investment when that president is inaugurated, and then when your presidential party of choice goes out of office, you pull your money out of the market. And so as we can see on the far left-hand side of the screen, if you had your funds invested only when a Republican was in the White House, this is for the S&P 500 from 1961 until 2023. So we don't have data all the way through 2024. This comes from a Charles Schwab article that they wrote. And you can see that for a Republican, your returns of a $10,000 investment over that period of time would have been about $102,000. So your $10,000 grew to about $102,000. If you only invested while a Democrat was in the office, pulling your funds out when a Republican was in the office, you would be at about $500,000. Now, both of those are not great when you compare them to the $5.1 million that you would have if you just stayed invested over the course of time. And this comes back to that initial quote that we had, where politics intrinsically are making us more and more stressed out. And when we have this stress and these emotions rise to the surface, we can make irrational decisions. And so we want to come back and ask the question, well, what should we do? How do we respond? The reality is we need to make a plan. So for those of you all that are clients and work with us, continue to come back to what is that financial plan? What are those goals that we have set alongside you? What are those dreams and visions of the life that you want your resources to provide for you? And then when we see those, let's stick to that plan. Let's not allow any of these spikes, whether it's funds are up 20% or funds are down 20%. We want to be long-term investors saying it is better to be holding funds in the market long-term, selling strategically, and not changing things up when we feel an emotional spike. The next thing we could do is when we feel those stressors, find an outlet for your stress. We need to take a step away. If you know that every time you turn on the news, your blood starts to boil, maybe it's time to turn the news off, take a step away from the news, and go take a hike. If you like being outside, go garden, go play with your kids or your grandkids. Find an outlet for that stress so that when it comes, you know what to do with it, which is not selling your funds and putting them under the mattress. Clients, we would love to have conversations with you about these types of things. When election stress gets you nervous, come to us. Let's talk about your goals. Let's talk about that vision for the ideal life that you've dreamt of. As we say every time, our advisory services are offered through Retirement Planning Services. Past performance doesn't indicate future results. All the indices that we referred to, those rates of return, they're unmanaged and you can't invest into them directly. With that, we hope you enjoyed the State of the Markets update. Feel free to leave comments down below, and we'll see you next time.
If you like these financial planning videos, please share with a friend, and if you have questions, go to our website at SiriusRetirement.com.
This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.